welcome to today's episode. So today we'll be going over what's referred to as Elliot Wave theory. So as you can see here, this is an example of an Elliot wave, and in general the stock market can be often seen as something that is random and impossible to predict, whereas according to the Elliot Wave theory, this essentially suggests that the stock market behaves in a series of repeating patterns essentially, and these patterns repeat over the long term, and as you move into the smaller term, these patterns appear on a smaller and smaller basis within the larger Elliot wave, all the way down until the smallest price movements. And so I'll flick onto Investopedia now and just read you an explanation of what this is, and you can do more research. There's also a website called elliotwave.com where there's a lot of resources if you're interested in researching any of this further. So I'll read the website here. So, Introduction to Elliot Wave Theory, and this is just an introduction because it is a very you can get very broad and in depth into this. So yeah, so Introduction to Elliot Wave Theory. Ralph Nelson Elliot developed the Elliot Wave theory in the 1930s. Elliot believed that stock markets generally thought to behave in a somewhat random and chaotic manner, in fact traded in repetitive patterns. In this article, it will discuss and take a look at the history behind the Elliot Wave theory and how it is applied to trading. Waves. Elliot proposed that trends in financial prices resulted from investors' predominant psychology. He found that swings in mass psychology always showed up in the same recurring financial patterns, or waves, in financial markets. Elliot's theory somewhat resembles the Dow theory in that both recognize that stock prices move in waves. Because Elliot additionally recognized the fractal nature of markets, however, fractal is just a repeating pattern. However, he was able to break down and analyze them in much greater detail. Fractals are mathematical structures which, on an ever smaller scale, infinitely repeat themselves. As I said, Elliot discovered stock index price patterns were structured in the same way. He then began to look at how these repeating patterns could be used as predictive indicators in future market moves. Market predictions based on wave patterns. Elliot made detailed stock market predictions based on reliable characteristics he discovered in the wave patterns. An impulse wave, which net travels in the same direction as the larger trend, always shows 5 waves in its pattern. A corrective wave, on the other hand, net travels in the opposite direction of the market trend. On a smaller scale, within each of the impulsive waves, 5 waves can again be found. So this is where the fractal nature comes into play. The next pattern repeats itself ad infinitum. Infinitum, I think I said that right, at an ever smaller scale, and this just goes smaller and smaller. So you can trade an Elliot wave as a day trader, as a swing trader, as a position trader, and I'll discuss what these different types of trading is in a later video. Elliot uncovered this fractal structure in financial markets in the 1930s, but only decades later would scientists recognize fractals and demonstrate them mathematically. In the financial markets, we know what goes up must come down, as a price movement up or down is always followed by a contrary movement. Price action is divided into trends and correlations. Trends show the main directions of prices, whilst corrections move against the trend. Now, if you want to watch this video, you can just type in Elliot Wave Investopedia. I don't know if I'll get a copyright strike for playing that video. Elliot Wave theory interpretation. The Elliot Wave theory is interpreted as follows. 5 waves move in the direction of the main trend, followed by 3 waves in a correction, totaling 5 to 3 moves. This 5 to 3 move then, or this 5-3 move, then becomes 2 subdivisions of the next higher wave move. The underlying 5-wave pattern remains constant through the time span of, though the time span of each wave may vary. So let's have a look at the following chart made up of 8 waves, 5 net up and 3 net down. So so as the Elliot Wave says, you have an up and then a correction, and then an up and then a correction, and then an up. So that's essentially the Elliot Wave. So up 3 times, down 2 times, and then at the top here we can see a head and shoulders pattern, which is where the shoulders there and the shoulders there, the head's there. So as the second shoulder begins to fall, especially if it falls below the support here, then you would know that that's an opportunity to short. So waves 1, 2, 3 and 4 form a 5 and 5 form an impulse, and waves A, B and C form a correction. So this is the correction here. The 5-wave impulse in turn forms 1 wave at the next largest degree, and the 3-wave correction forms wave 2 at the next largest degree. So as you can, I've clicked on the full image, So as you can see here, you have 1, 2, 3 down, and you have 1, 2, 3 up, and then you have 1, 2, and that would continue down as the Elliot Wave. Let's see if there's a way I can click off this. Oh no, it's opened a new tab. Oh no, it's just being strange. Maybe if I can do this. Nope. Right, I'll just type it in again. That was strange. So as you can see here, note that in this picture waves A and C form A and C move in the direction of the trend at one larger degree, and therefore are impulsive and composed of 5 waves. Wave B, in contrast, is counter-trend and therefore corrective and composed of 3 waves. An impulse wave formation followed by a corrective wave forms an Elliot wave degree consisting of trends and counter-trends. As you can see from the patterns pictured above, 5 waves do not always travel net upwards and 3 waves do not always travel net downwards. When the larger degree trend is down, for instance, so is the 5-wave sequence. Wave degrees. Elliot identified 9 degrees of waves, which he labelled as follows from largest to smallest: grand supercycle, supercycle, cycle, primary, intermediate, minor, minute, minuet, subminuet. Hope I'm saying that correctly. Since Elliot waves are fractals, wave degrees theoretically expand over larger and ever smaller beyond those listed above, so it's infinite, essentially in theory. To use the theory in everyday trading, a trader might identify an upward trending impulse wave, go long and then sell short the position as the pattern completes 5 waves and a reversal is imminent. Elliot Wave theory's popularity. In the 1970s, the Elliot Wave principle gained popularity amongst the work of A.J. Frost and Robert Prechter in their now legendary book, Elliot Wave Principle, Key to Market Behavior. The authors predicted the bull market in the 1980s. Prechter would later issue a sell recommendation days before the crash of 1987. The bottom line. Elliot Wave practitioners stress that simply because the market is a fractal does not make the market easily predictable, which is true. You should use this in conjunction with other indicators and mix your strategy as much as you can and tailor it to what suits you best. Scientists recognize a tree as a fractal, but that doesn't mean anyone can predict the path of each of its branches. In terms of practical application, the Elliot Wave principle has its devotees and its detractors like all other analysis methods. One of the key weaknesses is that the practitioners can always blame their reading of the charts rather than weakness in the theory. Failing that, there is the open-ended interpretation of how long the wave takes to complete. That said, the traders who commit to Elliot Wave theory passionately defend it. So let's show you some more images before we go. Here's one of euro to US dollar. Here you can see wave 1, wave 2, wave 3. And we've got another one here. That one's not very well detailed. Neither of these, but as you've seen, it was able to show you on Investopedia, and you can do some more research yourself. So we'll bring this episode to an end, and thank you for watching. Bye for now.